Equity is the last financial element someone will find in the balance sheet. Remember the basic accounting equation, assets equals liabilities plus equity. So the amount of equity equals assets minus liabilities. And sometimes the equity is called net worth, meaning that what remains from the assets after deducting all the liabilities. Okay, this is the net worth. Now, depending on the type of the business organization that you have, you may see equity with different names. Equity is the generic name. Like if you are a corporation, usually they use the term stockholders equity. If the business is a partnership, they use partners equity. And if you're a sole proprietorship, they use the term owner's equity. Now, equity consists of two different types of funds or money for the business. The first element of equity is capital. Capital is money that has invested into the business by its owners, by its investors. And sometimes they use different names. You may find it different names in the balance sheet. You may see it as a capital stock, share capital, or paid-in capital. Okay, all of these terms can be used with exactly the same meaning. Now, remember that for investors, capital gives them ownership rights. So like, for example, 40 or 50% or 100% of ownership, or maybe very low level of ownership. Also, since you have ownership rights, investors also, they have the right to receive a reward from the profitability of the business in the form of dividends. So let's say, for example, if at the end of the year you have profits of $100,000 and you decide to give all of it or some of it to the owner. So depending on the ownership rights, each investor receive its appropriate percentage. The other element of equity refers to the retained earnings, or sometimes I call it the retained profits or retained income. So this is money from the profits of the business that has been reinvested or has been retained into the business. Let's say an example here to understand the meaning of retained earnings. So we have a firm that has net income for the year of $100,000 and at the end of the year decides to give 50% of its profits to its owner. That means that $50,000 will be paid to the owners as dividends and the remaining $50,000 will stay in the firm as retained earnings. Okay, so we have, again, $100,000 of profits, so 50% goes out as dividends to the owners, to the investors, and the remaining $50,000 is reinvested or is retained into the business. Here are the elements of equity. Again, there are different ways to describe that and show it. We have capital or capital stock. This is investors' money. In this case, we have by December 31st of 2003, $450,000 of equity from investors. And again, capital accumulates, meaning the capital from the beginning of the business operation up to this point of time. And here we have the reinvested profits up to the previous year, $570,000. And these are profits that has been retained into the business for this year. Okay, again, if you want, you can combine both of them together. It's not going to change the story. So we have here capital, investors, accumulated money. And here we have money that has been retained into the business from its profits, from the beginning of its operation up to this point of time. This gives us the total amount of equity. Also, another thing you have to remember is that the retained earnings accumulate from the time the business is created. Here I have an example to understand the accumulation of retained earnings. So let's assume that a business has retained earnings for the first 3 years of its operation. Let's say in the first year the retained earnings were $5,000, year 2 $10,000, and year 3 $15,000. So in the balance sheet, the total amount of retained earnings will be the following. At the end of year 1, $5,000. Why? This is from year 1. In year 2 will be $15,000. Why? Remember, accumulate. Year 1 plus year 2. 5 and 10 equals 15. And also in year 3, it will be 30. Why? Because we accumulate all years of retained earnings. 5 plus 10, 15 plus 15, $30,000 of retained earnings for the first 3 years of its operations.